with Mitch.
Hi, it's time for A Minute with Mitch again. And today we're going to talk about birthdays. And you're going to wonder about birthdays and finance or your wealth. What does that have to do with anything? There are 10 birthdays once you get to age 50 that can affect the different parts of your wealth and your money. And I'm going to talk about them for you. So for example, at age 50, if you have an IRA and you haven't contributed the full amount, you can actually add a little more money to it each year, and that's called the catch-up. At age 50, you can do a catch-up to your IRA. At age 55, if you're retired and you want to take some money from your IRA, you have it's called the Rule 55. It's a catch-up provision, which means if you need to start taking money out of your IRA early, because remember, at 59 and a half, you can start taking money out of the IRA without the 10% penalty. However, at 55, this catch-up, this new ruling, you can take money out, but you have to take the same amount out for the next 5 years. So you have to, once you start at 55, you have to take it out for 5 years and the same amount, and then you would avoid the 10% penalty. Age 60, it allows either a widow or a widower to start taking Social Security out, and you don't have to wait until you're at least 62, or you want to wait until your maximum, somewhere between 66 and 67 currently. So you could actually take widow or widower Social Security benefits at age 60. At age 62, that allows you to start taking out your own Social Security, discounted benefits because you haven't reached your maximum Social Security age yet. And then, of course, we get to age 65, Medicare. You start up to sign up for your Medicare at age 65, and that is for the government medical program and the government drug program. Age 66 to 67, somewhere in that range, you can start to take your full Social Security. You have all these decisions, and I'd recommend checking on SSA, the government Social Security website, sign up, take a look, see what your numbers and options are, and if you have a question, you can get in touch with me or anyone at Security Financial Management, and we'll run some numbers for you based on what Social Security told you and help you try to make a decision. Age 70 and a half. Remember, that used to be the old Social Security, I'm sorry, not Social Security, that used to be the old RMD, Required Minimum Distribution based on your IRA. Well, they've moved that up, but you can still take out up to $100,000 and donate it right to a charity. And by doing that, you don't have to pay the income tax. So say you wanted to make a $5,000 donation to any 501c3, which is an official charity, you could take that money and have your custodian, wherever your IRA is held, have them send that money straight to a charity, and you don't have to pay any income tax on it. And then, of course, we get to age 70. That's where you would also get your maximum Social Security. So if you deferred at age 65, 66, 67, 68, at age 70, that's when your Social Security actually maximizes. It doesn't go up anymore. So at age 70, you should start taking your Social Security if you've deferred and waited, and you'll get your maximum amount, but it's not going to grow anymore after age 70. You want to start there. And the final birthday, age 73. That's when your required minimum distribution must start from your IRA. The government tables from the IRS tell you exactly how much has to come out at age 73 if you've deferred taking money from your IRA all that time. So that's when you have to start under current law. They are talking about 2030, possibly raising that to age 75. But for now, if you hit age 73, you've got to start taking your RMD from your IRA. So with that, have a very happy Thanksgiving, and hopefully some of these happy birthdays gave you information you didn't know about. Thank you all.
1 minute with Mitch.